This podcast is for professional investors only.
Welcome to Robeco's Market Flash. Amid fluctuating tariff tensions, US bond markets have shown striking behavior, with investors selling treasuries alongside equities, a rare departure from convention. Beyond sharp price swings, long-dated US bonds have struggled to serve as a safe haven during a pivotal risk-off moment, raising questions about their role in today's markets. Martin van Vliet joins us now for some insight on this. Martin is a strategist in Robeco's global macro team. Welcome, Martin.
Hi, Erica.
Thanks for stepping away from your screens at this time.
Exactly, and it's also great to be able to talk about this instead of enjoying it yourself behind the screen.
Making history, right?
Exactly.
Martin, talk us through those days and hours of extreme market movements before the announcement by President Trump that he was pausing for 90 days the tariffs.
Yeah, obviously the week earlier we had heard the news about the reciprocal tariffs. I think January markets were shocked by the sheer scale of the tariffs. We saw immediately a reaction. Equity prices went down sharply, big moves on the day. And what you normally see then is that there's a flight to safety, that many investors buy government bonds because they are considered ultra safe, and they typically perform well in during times of turmoil. So bond prices then go up and yields go down. And that's what you saw April 2nd, April 3rd. And also into last week when the reciprocal tariffs were paused for 90 days. So that was the sort of the normal developments you see on bond markets and equity markets. But then all of a sudden, like the day before April 9th, we saw a very strange pattern. I mean, we were talking about it at the desk. All of a sudden, we saw US Treasury bond prices also going down. So especially in 10-year tenors, but also in 30-year tenors. So we thought, well, there are some auctions there, so the Treasury needs to borrow money, but it just continued and got worse. So then people started to question how safe are US Treasuries, and a complete breakdown of normal correlations. So it was quite something that day. So
what do you read into that? Is it, as you said now, that there was a complete lack of confidence because of unpredictable, volatile policy making that investors just didn't consider US long bonds to be safe? Was something else happening?
Well, obviously there are a number of potential explanations. So you started to discuss, is it that foreigners are getting nervous? Are they selling treasuries? For example, the Chinese government or the Japanese government, they also own a lot of treasuries. Were they not
Japanese insurers and Japan is the biggest bondholder.
Yeah,
right?
But you have like the official sector who owns treasuries, but like the governments, but you also have like the private sector. So there was a lot of discussion about, are the foreign official holders selling because they are being imposed with very high tariffs. But quite quickly, we also ourselves concluded that's probably not the case because they own a lot of shorter dated treasuries and not necessarily longer dated treasuries. So then the next potential explanation was, is it just that in a risk-off environment, people with very leveraged positions need to unwind those positions. So probably what was the real reason is that, for example, hedge funds were long treasuries and short swaps against it. They had to unwind. So I think it's just that in times of turbulence, you see where the crowded positions are, and they were in long treasury positions for sure, and they got squeezed out on that particular day. Yeah, and that obviously in itself also had an effect on the Trump administration themselves.
So do you think it prompted a change of behavior, even though everyone's denying it?
Well, I think Trump himself said that he was watching the bond market very closely, and he was getting a bit of yippee. I actually didn't know the word myself. But it immediately reminded me of this quote by a former advisor to Bill Clinton, who said, if there's reincarnation, I used to think I want to come back as a president or a great baseball player or the Pope, but I'm quite sure I want to come back as the bond market because I can intimidate everyone. And exactly, that's what happened. I mean, supposedly what triggered Trump into hitting the pause button was the turmoil in bond markets. Also the bond market intimidated Trump himself.
And through Treasury Secretary Bessent, perhaps, because he describes himself as the world's biggest bond trader. So
yeah, he's very much aware of the technicals, and he on that particular day, April 9th, said there's no problem to financial stability whatsoever. But yeah, obviously there's a lot of market chatter, and supposedly he was getting a bit worried. So he probably has said to Trump, listen, the equity market can go down, but if treasury yields go up, that has ramifications for the entire financial system, mortgage rates, everything is priced of treasury. So if that market doesn't function, then we potentially have a big problem. So I'm quite sure actually that it was the bond market that triggered Trump into a pause.
And how close do you think the US Treasury market was to some extreme dysfunctionality, collapse, disappearance of liquidity, for example?
Well, I think it was clear that something was going wrong there, but it was...
Because bid-ask spreads were widening.
Yeah. Well, the bid-ask, we obviously monitored that ourselves at the desk, bid-ask spreads in specific bonds, but it was not that extreme as it was during COVID. It was not as extreme as during the great financial crisis. So I think we were not at a point where people were starting to look at the central bank for intervention or support policies, because the Treasury themselves, they have a buyback program, they could step in. We have the Fed themselves who potentially could come to the rescue, but I think we were not there yet. But obviously the knee-jerk reaction of people in markets is to look and think about, we need the Fed or someone else, especially if you're in that position, you need to unwind. But I think if it would have continued for a couple of days, then definitely the central bank would become under pressure. Actually, on Friday, one of the Fed governors said, we are ready if it's necessary to intervene. And that already helped a little bit calm the situation.
Like verbal intervention.
Yeah, I mean, if you look at this week, the situation has calmed down a bit. Bond yields have also come down quite a bit. Equity prices obviously also has risen a bit further. So I wouldn't say it's the time is here to sound the all clear, because yield levels are still quite a bit higher than they were at similar equity price levels from more than a week ago. But I think it's also important to highlight that many investors have learned something from last week. When there's a lot of turbulence, when it's stormy waters, you want to see what is the real safe haven. And I think the German sovereign bond market, for example, still functions quite well, in the sense that people were flying into German bonds. So there are still quite some safe havens out there. Switzerland, Norway, Sweden, Germany.
They're
still
bond
the
markets
safest.
Or their currencies?
Well, no, I'm talking about the bond markets now. I mean, currency is another angle there. But no, for government bonds, what we saw last week when treasuries sold off, bonds actually did quite well. So,
but bonds in particular. So is this an endorsement of German fiscal policy, or is it just simply by contrast with the US?
No, I think the fiscal outlook in Germany, even though Germany obviously is going to borrow also a lot of money, is still much better than the fiscal outlook in the US and also in the UK, where debt to GDP levels are much, much higher than in Germany, even if I take into account all the extra borrowing in the next 10 years that Germany is going to do for defense spending and the infrastructure fund. So I think fundamentals do matter, but I think also the trade policy and other policies of the U.S. government, they're not making foreign investors more relaxed about investing in the U.S. more generally, not just the treasury market, but I would also say the equity market. So it's not just fiscal fundamentals, but it's also like the sea change in policies that are being embraced in the US, which I think have ramifications.
Yes. And you're still having to build your framework to understand this and price accordingly.
Yeah, I think, we are also foreign investors in US Treasuries.
And how nervous are you?
Well, I'm not nervous. It's always important to stay calm.
You don't look the type.
No. Well, you need to stay calm, especially if there's a lot of turbulence outside and it's stormy weather. No, but basically from the start of the year, we already were positioned for this. We already were underweight longer dated treasuries. We were overweight shorter dated treasuries because we were not compensate us as investors for the risks out there. And that's our job, right? We need to preserve the capital of our clients. We need to be making the right decisions. So there has been now repricing in longer-dated treasuries, but we are not sufficiently compensated yet, in our view, for taking neutral or overweight positions in longer-dated treasuries. We have better alternatives with better risk reward. So we are still underweight the longer-dated bonds and overweight the shorter-dated government bonds. And that position has actually helped us navigate the stormy waters last week.
Martin, final remarks. So you said you've been positioned correctly, appropriately all along, but in the last week or so, have you adjusted your positioning at all?
Yeah, well, we have obviously used the cheapening of longer-dated treasuries to lock in some profits, but we also have indeed become a bit more constructive on German bonds, because we now realize that equity markets have bounced, the situations have gone down. But this doesn't seem to be the end of the trade war. So we need to be ready for maybe a second wave of turmoil. So we become also a bit more constructive on maybe the true safe haven. And also we've took a bit of credit risk, because we haven't talked about corporate bonds. But corporate bonds got dragged along as well. Credit spreads also widened significantly. So we have started to add a bit of risk there, but more generally we remain cautious. But we are bond investors, so that's our job, to stay cautious, and every now and then we intimidate everyone.
Martin, thanks. So good talking to you.
Yeah, nice. It was a pleasure.
A man calm under extreme stress. And thanks to listeners. Stay tuned for more Market Flash updates from Robeco.
Thanks for joining this Robeco podcast. Please tune in next time as well. Important information. This publication is intended for professional investors. The podcast was brought to you by Robeco and in the US by Robeco Institutional Asset Management US Inc., a Delaware corporation, as well as an investment advisor registered with the US Securities and Exchange Commission. Robeco Institutional Asset Management US is a wholly owned subsidiary of Oryx Corporation Europe NV, a Dutch investment management firm located in Rotterdam, the Netherlands. Robeco Institutional Asset Management BV has a license as manager of UCITS and AIFs for the Netherlands Authority for the Financial Markets in Amsterdam.